Welcome back, everyone. Ready to dive into some more fascinating economic history.
Always.
Today, we're exploring the Bitcoin Standard by Saifedean Ammous. We've got some excerpts lined up that really get you thinking about sound money.
And how societies throughout history have wrestled with that concept.
It's such a fundamental thing, right?
Oh, absolutely. It gets to the core of how we exchange value, how we organize ourselves.
You know, Ammous starts off by laying out this problem of the coincidence of wants.
Yeah, it sounds simple enough at first.
But it can get messy fast when you think about the practicalities of barter.
Oh, for sure.
Yeah.
Like, imagine trying to trade a house for groceries.
You can't exactly divvy up your house into little pieces.
Right. And even finding a grocer who's in the market for a new house at the exact same time.
Talk about a long shot.
Exactly.
Yeah.
And then there's the issue of perishable goods. You can't just stockpile apples forever, hoping to trade them for something big later on.
And what if what you need is miles away? Transporting bulky items. Yeah.
Delicate things, yeah.
It just doesn't work.
Becomes a real logistical nightmare.
So this is where money comes in, right? The common medium of exchange to solve all these problems.
It has to be durable, divisible, portable to really work across different timescales and locations.
But Ammous doesn't stop at just money. He gets into what makes for truly good, sound money.
He focuses on saleability, which is basically how easily you can exchange something without losing value.
Makes sense. Like you wouldn't want your money rotting in your pocket.
Exactly. So you have this idea of saleability across time. Your money shouldn't decay quickly. It's like those giant ray stones they used as money on the island of Yap.
Those were durable, for sure.
Oh, yeah, incredibly. But you couldn't exactly use them for everyday purchases.
Can you imagine buying bread with a ray stone?
Uh-huh. A bit much, wouldn't it be? It's a perfect illustration of saleability across time, but not saleability across space.
They were fine for infrequent, large transactions, but for daily life, not so practical.
Not at all. And then there's the story of David O'Keefe. He came along and figured out how to mass-produce these ray stones, essentially.
It really threw the Mid-Abbey's economy for a loop.
Yeah, he created artificial inflation by disrupting the stock-to-flow ratio.
Which is basically the rate at which new units of money can be created relative to the existing supply, right?
Exactly. Ray stones naturally had a high stock-to-flow ratio, making them inherently scarce. But O'Keefe messed with that balance with his modern methods.
So it shows that even if something seems naturally scarce,
technology can come along and change the game entirely.
And that highlights why understanding stock to flow is so important when we evaluate what makes for good money.
Absolutely. Another great example is the agri beads used in West Africa. Their value was tied to the fact that glass making was rare and expensive there, so they had a high stock-to-flow ratio.
But in Europe, glass beads were worthless as money because glass making was commonplace.
Precisely. It wasn't about the material itself, but the relative scarcity and how easily that scarcity could be compromised.
So is Ammous saying that scarcity tied to the difficulty of production is key to sound money?
I think that's a core element of his argument, yeah. And he brings up seashells as another example.
Which were used as money in various cultures.
Like the wampum shells in North America, for instance. The rarest shells had the highest value, but then, as harvesting technology improved, their value plummeted. They basically stopped being used as currency.
So it seems like messing with the stock-to-flow ratio, whether intentionally or through these technological advances, can really shake up a monetary system.
It can have huge consequences, for sure.
Is that why Ammous is so wary of what he calls easy money?
That's definitely a major concern he raises. He uses the example of copper to illustrate this. Let's say the demand for copper explodes because people think it's the next big thing in money.
What happens then?
Initially, the price goes through the roof. You get a copper bubble. But that incentivizes producers to mine more.
And eventually,
the market gets flooded with copper. The bubble bursts. And those who bought in at the peak are left holding the bag.
Ouch. That sounds a lot like those speculative bubbles we see today.
The parallels are definitely there. And that's why Ammous is so critical of government-controlled money. You know, what we call fiat currency.
Because they can basically print money at will.
Which means they can manipulate the stock-to-flow ratio artificially.
Leading to instability, ultimately hurting those who are trying to save and maintain their purchasing power.
Exactly. That manipulation, that ability to create easy money, is a thread that runs through so many of the historical examples Ammous looks at.
He contrasts this with the historical stability of gold, which has a relatively fixed stock to flow.
Making it much more resilient to this kind of manipulation. Think about the Roman Empire and their coinage,
Yeah.
the denarius and the aureus.
Right. Ammous points out that the debasement of those coins, like clipping them to create more,
Which was essentially a way to inflate the money supply.
it contributed to Rome's economic decline.
Fascinating case study. The empire thrived when its currency was sound. But then emperors like Nero started debasing the coins. Inflation took hold, and the empire's economic foundations weakened.
So, tampering with the money supply, whether through debasement or just printing more?
It seems to lead to trouble, historically at least.
And then Ammous contrasts Rome with the Byzantine Empire. Their gold coin, the bezant, stayed stable for centuries.
Helping to contribute to their longevity as an empire. A pretty stark contrast there. Sound money seems to go hand in hand with stability and prosperity.
While unsound money sets the stage for decline.
That's a key takeaway from this part of the book, for sure. But it doesn't end there. The 20th century saw a huge shift away from gold-backed currencies.
Toward government-controlled or fiat money.
And Ammous argues that this shift was heavily influenced by World War I. It really changed the global monetary landscape in a profound way.
So the war kind of forced governments to ditch those sound money principles out of necessity.
It seems that way. And they did try to go back to the gold standard later on. Ammous argues that they went about it the wrong way. They were trying to return to pre-war gold prices without acknowledging all the inflation that had happened in the meantime.
So trying to force the system back to a pre-war state.
It just created more instability.
A recipe for disaster, it sounds like.
And, according to Ammous, it contributed to the Great Depression. The interwar period was just riddled with economic turmoil, which of course led to another global conflict, World War II. And then after that, the whole monetary system gets reshuffled again with the Bretton Woods Agreement.
Right, the agreement that established a new global system based on the US dollar, which at that time was pegged to gold.
Yeah, other countries then pegged their currencies to the dollar. It wasn't a pure gold standard, but more like a gold-backed dollar standard.
But Ammous points out that this system still had a fundamental flaw.
It still relied on government-controlled money.
And
Governments are always tempted to inflate the money supply.
which leads to devaluation.
Right, so even though the dollar was pegged to gold, there was still this vulnerability because the government could just print more dollars, potentially exceeding what their gold reserves could actually back.
Makes sense. And that vulnerability led to the collapse of Bretton Woods in the early 1970s.
And from that point on, we've been living in a world dominated by pure fiat currencies.
Which Ammous sees as inherently unstable and unsustainable.
That's his view, for sure.
So where does this leave us then? What are the long-term consequences of this shift to unsound money?
Well, that's a big question. And Ammous explores it in depth by connecting sound money to this concept of time preference.
It's so interesting how he ties these economic principles to human psychology and societal values.
Really fascinating stuff.
Let's dig into that more in part 2 of our deep dive into the Bitcoin standard.
Okay, so let's dig into this whole time preference idea. How does it connect to sound money? It might seem like a bit of a jump.
It does, yeah. But Ammous makes this really compelling argument about how these concepts are intertwined.
Yeah, he does. It's not just about the economics, right? It's about how money actually influences our behavior.
Our choices, how we plan for the future.
Exactly. So Ammous argues that sound money tends to encourage a low time preference,
Meaning?
meaning that when people believe their money will hold its value over time,
They're more likely to save and invest.
they think long term.
It's like having a solid financial foundation. If you're constantly worried about inflation eating away at your savings,
Yeah, you're not going to be thinking about the future as much.
you're more focused on immediate needs.
Exactly. It's about instant gratification in that case. Think about it like this. Someone choosing to invest in a college education versus going straight into the workforce. Or someone saving for a down payment on a house versus racking up credit card debt for instant gratification.
Those are big decisions.
They are,
Yeah.
and they reflect our individual time preferences. But Ammous is saying that sound money can cultivate a societal low time preference.
Leading to greater stability and prosperity overall.
Exactly.
Yeah.
Societies with a lower time preference, he argues, well, they tend to be more patient.
More planning, more delayed gratification, and all those things can lead to stronger economies and more robust social structures.
He even links it to stronger family and community ties.
Because?
Well, because that sense of financial security can foster stronger relationships. People are more willing to invest in the future, not just for themselves, but for future generations as well.
It's a pretty optimistic picture he paints of how sound money can contribute to a flourishing society.
It is.
Yeah.
But then, of course, he flips the script and looks at what happens when you have unsound money.
A system that incentivizes a high time preference.
Right. You get more impulsivity, focus on short-term gains, less saving, less investment in the future. It can lead to a sort of societal unraveling.
Is that what he's suggesting?
Well, he does argue that a high time preference can contribute to a breakdown of family and community values. People become more self-centered, less willing to make sacrifices for the long term. It's a thought-provoking argument for sure.
It really makes you think about the ripple effects of our monetary system.
It does. And this is where Ammous's critique of central banks comes into play.
He sees them as a root cause of many of these problems.
Especially their control over the money supply.
Right. He's drawing from the Austrian School of Economics here. Very critical of how central banks manipulate interest rates and the money supply. He brings up this Austrian business cycle theory, which tries to explain those cyclical booms and busts we see in economies.
Oh yeah, it's a fascinating theory.
I've heard of it, but it always seemed a bit complicated. Can you break it down for us?
Well, basically the theory says that when central banks artificially lower interest rates,
What happens?
well, you get a surge in lending and investment. Makes sense, right? But the problem is this boom is often built on an illusion.
Okay, how so?
Because those artificially low rates, they make it seem like there's more capital available for investment than there actually is.
Ah, I see.
So businesses are encouraged to take on more debt and invest in projects that might not actually be viable under normal circumstances.
It's like building a house on sand.
Exactly. There are what economists call malinvestments. Resources are poured into ventures that ultimately aren't sustainable.
And eventually, the bubble bursts.
The illusion fades. The economy contracts. And you get a recession.
So these cycles of boom and bust, according to this Austrian business cycle theory,
They're a direct result of that central bank intervention. Ammous thinks that letting the market determine interest rates would lead to more sustainable growth in the long run.
interesting. And then he introduces this term, bezel.
Ah, yes, the bezel.
It's always sounded like such a strange word to me. What does it actually refer to?
Well, think of it as the hidden wealth created by inflation,
Hidden how?
because it disproportionately benefits those who are closest to the money creation process.
Governments, banks.
The people who get their hands on that newly created money first.
But that comes at the expense of everyone else, right?
Right. Because everyone else's savings are losing value as that new money floods the system.
Ammous sees this bezel as a major driver of economic inequality.
It distorts incentives, for sure. It creates a system where the people in power benefit at the expense of ordinary savers and wage earners.
It's a pretty harsh assessment of the current system.
It is. But then Ammous brings up Bitcoin as a potential solution.
A way to return to those sound money principles, but in the digital realm this time.
He sees Bitcoin as having the potential to really disrupt things.
To change how we think about money and finance.
Yeah, it's a pretty revolutionary idea.
Okay, so let's unpack that a bit. What exactly is it about Bitcoin that makes Ammous so optimistic? So Ammous sees Bitcoin as this potential game changer, but what makes it so different? It seems like he's getting pretty technical now.
He gets into the nuts and bolts, yeah. But he manages to explain things in a way that anyone can grasp.
Even if you're not super tech savvy.
Exactly. It's pretty impressive, actually.
He uses this analogy of Bitcoin as a giant public ledger, like a record of every transaction that's ever happened on the Bitcoin network. That radical transparency is what's so intriguing.
That's a great way to visualize it. And what makes it even more revolutionary is that this ledger is distributed across thousands of computers worldwide.
So it's not controlled by any single entity.
No central authority, no
Or-
single point of failure. It's like this massive decentralized spreadsheet that anyone can view and audit.
So it's incredibly resilient.
Yeah, that resilience is one of Bitcoin's key features for sure. And this is where the blockchain comes in.
Okay, blockchain. It's a buzzword we hear everywhere these days, but it can be hard to wrap your head around.
Think of it as a chain of blocks, with each block containing a set of verified transactions
And they're linked together.
cryptographically,
Right.
creating this chronological, tamper-proof record of every Bitcoin transaction ever made.
So if someone tried to alter a past transaction,
It would be like trying to change a single link in a chain without anyone noticing. The whole system would reject it.
that makes sense. It's a pretty ingenious system.
It is. This combination of cryptography and decentralization is what makes Bitcoin so secure. And as Ammous emphasizes, it's the first time in history we have a system for transferring value that doesn't require trusting a third party.
No banks, no governments, no middlemen.
It's peer-to-peer, built on math. A radical departure from how we've always thought about money.
But how are new Bitcoins created? I know there's this whole mining thing, but...
Mining is how new Bitcoins are introduced into circulation.
Okay, but what does that actually involve?
Well, you have these specialized computers called miners that are competing to solve complex mathematical problems.
It's like a digital gold rush. They're racing to unlock these digital treasures.
That's a good way to put it.
Mm-hmm.
And the reward for solving these problems is a certain amount of Bitcoin.
Right, so the more miners there are?
The more secure the network becomes.
That's pretty elegant.
It is. And the other crucial thing about mining is that it ensures a steady and predictable issuance of new Bitcoins.
Which prevents that arbitrary inflation we see with fiat currencies.
Exactly. Bitcoin's monetary policy is governed by code, by algorithms, not by the whims of politicians or central bankers.
He really goes deep on how those transactions are recorded on the blockchain, how they're broadcast across the network.
It's a fascinating glimpse into how this technology actually works.
And all of this leads to Ammous's main argument.
That Bitcoin has the potential to solve many of the problems we've been talking about.
The issues stemming from unsound money, central bank manipulation, government overreach.
The erosion of privacy, all of that.
Ammous envisions a world where Bitcoin empowers individuals.
Giving them more control over their financial lives.
And enabling a more stable and equitable economic system.
It's a bold vision for sure.
But he doesn't shy away from the challenges either.
Oh, absolutely not. He acknowledges that Bitcoin is still in its early stages. There are hurdles to overcome. Resistance from governments, financial institutions, and there are still technical complexities to work out.
Price volatility is a big one, too.
Right. But he sees these as growing pains, challenges that will be addressed as the technology matures and as adoption grows.
It's a gradual shift, he thinks, away from this broken system towards a new paradigm based on those sound money principles.
It's about putting individuals back in control of their financial destinies.
It's definitely a thought-provoking vision, whether or not you're fully on board with the whole Bitcoin idea.
Ammous forces us to ask some hard questions.
About the nature of money, its role in society.
If sound money is so crucial for individual well-being, for a flourishing society...
Where does that leave us today?
Exactly. What are the implications for our current system? And if Bitcoin really is a viable alternative, how could it change things?
Those are big questions, and Ammous doesn't pretend to have all the answers.
He gives us a framework for understanding the issues.
And challenges us to think critically about the future of money.
It's a must-read, whether you're an economics buff or just curious about this whole Bitcoin phenomenon.
Well, that wraps up our deep dive into the Bitcoin standard. Thanks for joining us.
Always a pleasure.
We hope you found it insightful. Until next time, keep those minds curious.